Then we move to today's program. Like I said, we'll start with a session on issues related to financial instruments and specific transactions.
Yes, hello, good morning. Pleasure to be here, maybe quickly. So I've been working for the European Central Bank in Frankfurt for quite a while. And before this, for the German Central Bank in business cycle analysis. So I'm gonna go through a quite Okay, so if you didn't hear it, I've been working for the European Central Bank for Okay. So I'm an old central banker. To summarize it, started out at the German Central Bank and then for the European Central Bank. Half a year, I had the pleasure to work for the Maltese Central Bank, which had to introduce all the statistics required to be a Euro area member state. Now you hear me? Yes. Okay. So I have quite a bit of experience, I would say, so don't feel free to ask me questions at any point in time. We have the presentations I'm doing are basically based on a seminar we are also doing at the European Central Bank. They're quite detailed, quite long. I don't know what's your level, so maybe I'm too fast for some, maybe I'm too slow for others. Feel free to stop me at any time. So I'm going through basic concepts about financial instruments. I will concentrate here a bit on the more difficult ones. I think you know what financial assets are. Generally, financial assets are claims against a debtor. So an asset is generally also a liability of another sector. The only exception is monetary gold, held in the form of really physical gold or allocated gold accounts that the central bank has claims to. So, question to wake up. What about gold held by a household? Is this a financial asset? The answer is very quick. No, it's not, right? So if you hold gold, it's a valuable. It's not a claim against anybody else. Only if a central bank holds gold as part of monetary assets, because it's easily convertible into other means of exchange, it's considered financial assets, but that is really the only exception where a financial asset is not a liability of another party. Consolidation is the offsetting or deducting of financial positions within a certain group of institutional units or between sectors. You might know it from government accounts. Here we like to look at consolidated government account. We are deducting the debt of government which is held by other government units. because we consider this as less relevant. So it depends a bit on the use of the data, whether one prefers consolidated or non-consolidated accounts. But in some cases, it also depends on data availability. Generally, the financial accounts for households are basically consolidated because we do not have a data source for loans granted between households, for example. Netting should be done only within a specific financial instrument. Netting means we, in a given, let's say you have quarterly data, you have cross flows, unit buys and sells securities, and you only record the net transactions on the asset side of buying and also on the liability. So it could be a unit issues, government issues, 100 billion in securities in a quarter, but also redeems 20, what you record is 80. Simple as that. This netting is only done separately on the asset side and the liability side. You shouldn't generally net between assets and liabilities. So let's say government unit issues securities and buys securities, you would not consolidate or net the two. However, in some cases, like for financial derivatives, you might only have access to net data. You only see the net flows in a given time period. Or maybe you only have the end of period stocks and you from this have to deduct the flows, which are then by construction netted. Time of recording, you might have heard this. So in principle, we should always apply the accrual. That is irrespective of when the actual payment is made. You should record when the event occurs. So if a tax is due but not paid, you still record it as tax payable. And if it's not paid, you have other accounts liability. Negotiable instruments. We distinguish between securities, which are by design tradable, easy to exchange between parties. And the only thing that I want to point out here is it's really the design. You don't need to check whether an individual security is actually traded. Doesn't have to be listed on an exchange. If it's designed to be traded, generally we say if it has an ISIN code, then it's easily exchanged between parties, and that determines its classification as a security, not the actual trade, which is really important for statisticians because you know ex ante this instrument is designed to be tradable. It is a security. You don't have to wait where the trade takes place. Another thing is contingent assets and liabilities. In the financial accounts, I tend to say we generally respect the legal reality. So only if something is really an asset or a liability, we record it. We don't record it if there are commitments which are not legal or may depend on certain events. An exception from this is insurance, where you have very many similar cases, so you can estimate the likely value of a commitment of an insurance corporation. And the other example is standardized guarantee. Let's say government guarantees student loans granted by an MFI. Again, you have a large amount of individual loans. You can estimate the likelihood of government having to pay is maybe 5% of the outstanding amount. This you can record. But other one-off guarantees you don't record in general because the value is uncertain. Similarly, in the core account or in the sequence of the national accounts, you don't record Social Security. Here I would say the reason is slightly different. Social Security pensions, for example, represent less of a legal certainty. Parliament, basically in most countries, can decide to adjust pension liabilities, increases at least. So these Social Security pensions and other unfunded government pension funds are generally not recorded in the core accounts. It's also because households cannot go to court and say, look, I have a contract with this institution, they have to pay me. In the case of Social Security, government can change the value, and then you cannot go to court. To put it a bit provocative. Now this doesn't work. Sorry. Now let's see, did I go too far? So these were just a few highlight of the not so intuitive basic concepts, I would say. The instrument classification, that's something I assume you know. But if you have questions about some borderline that you run into, please ask. I don't want to repeat the international standards. I put it there so you have a bit of an anchor. Please tell me. I always have a problem distinguishing between loans and deposits, for example. Any issues with the limitation between financial instruments? It's perfectly clear. Okay, then I will go to more specifics, but here I think I can save a bit of time. You have the presentations. Ideally, you have looked into them already. Of course, I meant to fully follow the international standards. At the ECB, our guideline says we follow ESA, the European System of Accounts. So different from other statistics, we don't come up with our own concepts. Well, maybe we add some details, but we really follow the international standards, and in Europe, particularly the ESA, which is now being reviewed. This is why Louis probably can't be with us. The work is really going on now because you probably heard this. The international standards are pretty much agreed upon the review, and this now has to be implemented in the European standards, which are meant to be fully in line, but in certain aspects more detailed reflecting the European situation. So I just click through here, giving you a chance if you have questions. Yes?
What about the SDR allocation?
Yes.
It's treated as a loan, but whose loan? Is it the loan of the central bank or the government? Because that is issuing.
Well, the SDR
SDR
allocation
allocation, yes.
itself is a separate instrument. Right?
Okay.
So the participating central banks, they agree we increase the amount of special drawing rights in circulation. So that once this is agreed, the allocation to the central bank creates a liability of the central bank. Basically a pre-commitment to exchange SDR requirements for currency. But I'm speaking under the control of the IMF here, who are really in charge.
I'm just asking how EU and ECB are regulations about it. How should this SDR allocation be classified?
So it's a financial transaction, an equal amount on the asset and liability side. And so initially, assets and liabilities in SDRs are the same. But then a country might use parts of its SDRs. That is, it can sell SDRs against other foreign exchange. Emmanuel? Yeah. You have a follow-up question? Very good.
We just discussing that it should be Ministry of Finance or central bank, depending on who use this SDRs.
Yes,
Because
in the euro area, it's generally the central bank. But in principle, also government or other government institutions can be holders of SDR.
Yes.
But in the euro area, I think it's always at the central bank. Yes.
So when the central bank is the first opposite of the IMF in SDR allocation, the relation between central bank and the government unit, S12 one and the S13, the interaction between the asset side is currency, liability side will be loans or other accounts. So central government should record the SDR assets on the central bank in loans or other accounts. We try to discover that.
I'm not sure.
Okay,
It's
maybe
it's either or. Either the central bank holds the SDRs or the central government.
we record it in the central bank's balance sheets because the transaction between IMF and the Turkish central bank. But we think and we take some recommendations from IMF that we do it by the name of the central government. So we should record it as we have the deposits for the central government, and we have liability in the central governments as loans from the central bank. So I can.
Emmanuel, you So it could be the central bank makes the funds available to the government.
gov-
Well, not in the euro area, but yes, in principle that can be the case.
Loans is
And then
okay.
it depends on the nature on how these funds are made available to the government. I mean, is it interest bearing? Has it a time limitation? Then it's would certainly be a loan. Okay. So I see, good questions. I don't go into every detail, but very good. Ask detailed questions if you have them. Yes, currency deposits, you should know the definitions, but ask if you have questions. Transferable deposits are really just deposits that are without any hindrance transferable or into cash or to make payments. Debt securities, I mentioned already, so we use this ex-ante criteria, are assets, liabilities that are designed to be traded. Of course, we always distinguish between short-term and long-term, both for debt securities and loans. In ESA, the standard cutoff is up to 1 year, including 1 year and over 1 year of original maturity. Sometimes users would like to have remaining maturity. Of course, that would also be interesting, but yeah, the standard program is to classify them according to original maturity. Equity and investment fund shares or units are a bit special. I said assets are typically claims against a different institutional unit. In the case of equity and liability, in business accounting, you wouldn't call this a liability because it's not predefined, the value is not predefined. Equity is the share in the residual value of a corporation. It gives the owners claims on the profits, but they are not guaranteed a certain amount to be paid out. Similarly, investment funds, you carry the investment risk. It's only worth as much as the value of the assets of the investment fund, except for in some countries you have money market funds where there can be a guarantee that you get 100 back. So equity, we go a bit into the details here. Listed shares, obviously, are the ones listed at an organized exchange, at a stock exchange. Unlisted shares are securities. They are designed to be traded, but they are not listed on an exchange. Sometimes even big companies decide it's not worth it. We take a listed company private. We do not list it on the stock market anymore because it involves certain publication and certain other supervisory duties. So in a way, one can say the difference between listed shares and unlisted shares is not so big as it is between shares and other equity, because other equity is really not designed to be traded. There was some debate how to call it in the new SNA. I insisted we start with unlisted, with other equity. I think it's going to be called other equity and equity in international organizations. Other equity in many countries is quite important. You have some countries where every little enterprise really has shares outstanding, so they're in principle tradable, whereas other countries, like my home country, Germany, but also Italy or Austria, many companies have equity that is by design not tradable. It can only be exchanged upon agreement with the other equity holders. So in some countries, other equity is quite important. In some others, it's not. Yes, I think you roughly know what investment fund shares are. Collective investment undertakings. It helps investors to diversify. They don't have to buy many individual assets. They can buy a share in a pool of assets. Money market is the same, but doing it for short-term investments, whereas non-money market shares or units invest in shares or bonds. And still in Europe, we consider real estate investment funds, but that is up for discussion currently. Insurance, pensions, and standardized guarantees. I mentioned it already. So you have non-life, like car insurance, and although the individual household thinks not really as having an asset against the insurance, as it has, a car owner has to pay upfront the insurance premium. Typically, households have a bit of assets against insurance corporations from non-life. And also, of course, other companies, government can have short-term assets from non-life. But the really big amounts are in life insurance, because life insurance are often a bit of a hybrid. They insure maybe premature death or longevity, but they are also investment vehicles, so they typically collect large amounts. You typically have much higher values in life and also in pensions, because pensions accumulate over a long time typically to provide income in retirement. So how are we doing for time? I think I should go a bit quicker. In the Euro area, we just introduced the distinction between unit-linked life insurance, which work a bit like investment fund products. So you get whatever the value of your investments are. You carry the investment risk. Whereas the traditional life insurance products, the non-unit link, typically have a guaranteed or predefined benefits. The same distinction you can have, and we do make it for pension funds. You have the defined contribution pension funds. Defined contribution means the contributions are defined, but not the benefits. So again, it works a bit like an investment fund. The benefits depend on the return on your investment, whereas for the more traditional, the defined benefit pensions, the benefits are predefined either as percentage of your lifetime or your employment contributions, but they're predefined. So there's a big distinction in the investment risk. So it's not sufficient to say households in this country are more risk averse because they don't buy stocks, right? It depends. What type of pension do they have? What type of life insurance do they have? There can be big changes. So countries where households have unit-linked life insurance and defined contribution benefits, they are more affected by price changes in the markets. So that's why we thought it's important to introduce this additional distinction in financial instruments, and we do it now in the quarterly financial accounts of the ECB. It came up already, pension funds may be underfunded, right? If it has defined benefit obligations, the assets may run short because of market changes. And then it depends. I think we agreed with the Netherlands. We investigated this in the Netherlands. It's not always that the employer retains a responsibility. If the employer retains a responsibility, the pension fund has a claim on the employer in case of a shortfall. But if there is no such legal responsibility, that's what I meant earlier. In financial accounts, we kind of respect the legal reality, except for a few cases, we get to them, then we don't record. So it could be a pension fund is really underfunded and it's not made up by claims on a guarantor. If there's no guarantor, there's no claim. That's also a principle in financial accounts. You only record if there is really a claim on someone else. Standardized guarantees, I mentioned it before, example are student loans or export credits. That's a bit like non-life insurance. There are many similar cases. You can estimate what's the value of the insuree, what's the liability of the guarantor. Financial derivatives allow to trade risk with relatively little or no upfront investment. Only in the case of options, there's an upfront payment. In many other derivatives are designed such that initially their value is zero, but their value then changes depending on the underlying investment. As said, financial derivatives are the one area where you might allow netting. You cannot record all the gross flows. You might only have data on net values. Employee stock options, I don't know, 15, 20 years, they were important in Europe. They are important in the US, and maybe they become important in Europe again. It's basically just an option which is given to employees as part of compensation. thus they have to be accounted for as part of compensation and the value as a specific type of option. Other accounts receivable include both trade credits and advances. The distinction is trade credits and advances, F81, are related to timing differences of goods and services. So typical handyman does some work and gets the money 3 weeks later. In between, there is a trade credit, unpaid, for unpaid services. Whereas other accounts, other than trade credits, relate to time differences between distributive transactions. So late payments of social transfers, of wages, and interest rates. F89 is often used to align, or at least partially align, net lending, net borrowing. I will talk about this in a separate session. So it's not that by definition they should include the statistical discrepancy, but to a certain limit, countries use it to align net lending, net borrowing. And there are European recommendations kind of limiting the amount that you can adjust. This is the relevance. So not all instruments are relevant for all sectors, especially for liabilities, but also for assets. We said it, monetary gold can only be an asset of the central bank or general government. So that's not blanked out. That's how you have to read this table. Some cells in such a matrix, we know they shouldn't exist. Although working with many countries, we realized it's a priori, it's difficult to say something cannot exist, because we had the Italian colleague saying, no, in our case, there are households, maybe rich households, that have pension entitlement liabilities vis-a-vis their employees. So, okay, it's relevant. We didn't think so. Or other countries say insurance corporations sell a product that is really like a life insurance. It's an investment product like a life insurance, and it's not an investment fund. Okay, so we had to agree they can transmit it as a life insurance entitlement. Some compromises like this have to be made. On the liability side, I think there is general agreement. Households cannot issue shares, right? If they issue shares, then they are somehow have formed a corporation and it's not a household anymore. But I will, yeah, that would cost us too much time. But I have questions. Okay. Yes.
Thank you for presentation. My question is, the insurance corporations has on asset side insurance technical reserves. So it includes only reinsurance or
Yes.
the asset side, I mean.
On the asset side, I didn't speak about this. When we say insurance, we mean both direct insurance to households or corporation, but also insurance or reinsurance between insurance corporations. So most insurance corporations reinsure part of their risks with other, possibly bigger reinsurance corporations. So the fact that insurance assets is due to reinsurance. And maybe one thing is that we consider reinsurance always to be a non-life. So if a life insurance reinsures parts of its business, it has a claim in non-life insurance on a reinsurer, right? So there are no life insurance assets and claims between insurance.
Thank you. So asset side of insurance corporations includes only reinsurance, or there are other items also?
I mean,
I
in
understand it's
principle,
only
an insurance
reinsurance.
corporation could also insure its building with other insurance corporation, but I would say, yes, the assets of an insurance are claims from reinsurance. But one has to be careful. There are also other claims between insurance corporations. Sometimes insurance corporations have to make basically a payment to guarantee the claims. So there can be large, we record it under loan transactions related to insurance between insurance corporations. Yes? You're muted, not me.
Thank you. My question is linked to the previous one. If in asset side of life of insurance company, we see only reinsurance, then how could we treat prepayment premiums? For example, insurance company may insure their own buildings or employees, and how this pay in advance, and how these prepayments of premiums should be treated.
I wouldn't see a fundamental difference in the treatment. It's just the counterpart is within the insurance sector or with insurance in a different country. I should say reinsurance, that is the part of insurance that is often, or where you do see very large cross-border transactions. Because, yeah, there are a few very big reinsurer, also in the euro area, and we do see there is a lot of cross-border business going on. So this is something quite relevant for balance of payments or claims with non-residents. Whereas life insurance is 99%, I would say, in most countries, really residential.
So to draw a line in asset side of insurance company is only reinsurance, or including prepayment payments also?
I mean,
both of them.
we are getting into the premiums, the non-financial transactions. So here again, if an insurance pays insurance premium,
I'm hoping I understand your question correctly, but what happens is that the primary insurance company has taken basically, a policy, right? It's sold, an institutional unit a policy, And what it's done now is that in order to basically minimize its risk, it's taken that policy and it's basically sold it to a
Exactly. It's part of reinsurance. It's very clear. I mean, when a company make their own insurance and pay in advance these policies.
Sorry, I didn't hear that. Could you just please repeat?
We have two types of activity of insurance company. They insure others, and when reinsure this activity with other insurance companies, and it is like reinsurance on asset side of this insurance company. And we have cases when insurance company by themselves insure themselves or their buildings, their own employees, their own activity. And in there are cases when they pay in advance these policies. So these prepayments, like in monetary statistics, is called prepayment of premiums. How should they treat it here in our financial accounts? Should they be separate in our accounts, or should be they like a part of life of non-life insurance?
It's F61. It's non-life or prepayments of insurance premiums.
Yeah, it's not only reinsurance, but also these prepayments. That was my
Yes,
question.
yes. So
Yes.
in principle, yeah, an insurance corporation could also not just reinsure, but
Yes.
really insure its own building. I don't know if it's very relevant, but it can, it would not be treated. You want to keep the correct instrument. It is non-life insurance.
Yes, yes. Thank you.
I'm sorry. So they have the amount if they insure their own buildings. So they have on asset side and on liability side. Yes, the amount of insurance.
I mean, for this building that they
For
insure,
building.
they have assets.
But not
only-
liability?
If it's an insurance corporation,
Yeah.
it must have.
I mean, both asset side and liability side increases.
Yes.
My question is,
Yeah.
right?
Yes. But I would say the assets are 99% related to reinsurance, right? We actually have a similar case, pension funds. I was asked, yeah, but this pension fund has also a pension for its own employees. Yes, it's additional pension entitlements. Yeah, no, it was an insurance corporation. An insurance corporation can have pension entitlements vis-a-vis its own employees, but not directly related. I guess I should speed up. Because valuation, there are some more tricky elements. First of all, it's more of definition again, the difference between nominal value and face value. Nominal value is funds advanced plus interest. So here we have a zero coupon bond. Zero coupon bond is a very short-term debt security. Zero coupon means there is no actual interest payment. The interest is basically accruing over time by the fact that the investor pays maybe 90 and gets 100 back. Right, this is the example. You have a 2-year, yeah, so it's not that short term. So initially the investor pays 90. After a year, the instrument is worth 95. If he could sell it for 95, assuming the market interest rate is roughly a bit more than 5%. So we would say the nominal value at this time is 95. However, the face value, the face is what is written on the document, if there were still a document, is always 100. So it's an important distinction, especially in government finance statistics. Colleagues make the point, no, we want the nominal value or the face value. Market prices of negotiable instruments should definitely be at the current market price or possibly an estimation. Of course, you always want to convert the value of instruments to your local currency. For this, you need to use the current exchange rate. Maybe hurry up a bit more. That's an overview. Again, something where you might want to ask questions. It's a bit of a simplification. So for currency and deposits, we want the nominal value, not the face value, right? So if interest accrues, deposits, their value changes, even if there are no payments. Debt securities, definitely market prices, loans, always at nominal value. I have a slide on this. Even if it's rather clear a loan will not be repaid, in the core accounts, you always record loans at nominal value. Shares, ideally market price. Unlisted shares, you should estimate market prices. There are several methods how this can be done. I think we have a dedicated presentation on this. Only other equity of quasi-corporations. So not other equity in general, only other equity in quasi-corporations. Quasi-corporations are entities which are legally not really a corporation, but you consider it useful to treat them as a corporation. Only for them, you just use the own funds method, that is assets minus liabilities excluding equity. For insurance and pensions, it's not really written anywhere, but basically we accept the actuarial values. So what is in the supervised accounts of the insurance corporations and pensions, you don't have to estimate what would this life insurance portfolio be worth on the market. Basically, I think it's accepted. You accept what's in the books. Of course, not any accounting will do. You want to take the books as approved by the supervisors. So most countries have good data sources on insurance collected by the supervisor. Loans, I mentioned it, so always at nominal value, even if it's very doubtful that they will be repaid. This is a result of what we call the symmetry. You want to make sure the loans are still recorded at the nominal value in the books of the debtor. Thus, they should also be recorded at nominal value in the books of the creditor. The same applies to securities. You want to always record them at the same value for the holder and for the issuer. And this has, sometimes people consider this surprising. So also the value of the debt security of the liabilities of the issuer change due to market conditions. If interest rates go up, the market value of debt securities, also the liabilities, goes down. In principle, the issuer could repurchase the outstanding amounts for a lower amount. So economically, it can be justified, but it's surprising to some users. So market value of outstanding shares obviously fluctuates a lot. And I have an old example, but I updated it. Something that surprises financial people starting in financial accounts, the balance sheets don't have to be balanced, because we have independent valuation of its component. An extreme example, but you have this for non-financial corporations in general, is, for example, Apple. The amounts of its assets, Apple, the company, are rather negligible. Apple doesn't have a factory. It has plenty of cash, but compared to the market value of Apple, it's tiny. Why do we do this? We basically dissolve the equality of assets and liabilities, because, of course, we want to record the value of the shares of Apple held by households or other investors at market value, and we want to keep this symmetry. Thus, we have to record also the outstanding amount of the shares issued by non-financial corporations or financial corporations at market value. So in the exercises, you do a bit of balance sheet and transaction recording. If we find time, we go a bit into this. As said, for listed shares, it's quite obvious. You have the share price from the stock exchange. For unlisted shares, and sometimes, not a big example, Tesla is listed on the stock exchange, but at some point, Elon Musk says, I take the company private. I have a big investor. The rest I hold. No need to list it on the stock exchange. So it can easily change or quickly change. But you still want to record the true value of a company, even if it's unlisted. So you must estimate the market value. This can be done by comparing listed and non-listed corporations. Say, yes, Tesla is a bad example. It might be quite different from other car companies, but say Volkswagen is listed on the stock exchange. You know the stock price of Volkswagen, and let's say, parts of Volkswagen are Skoda and Seat. They are not listed on the stock exchange. So you can make relations. 10% of you compare the profits of Volkswagen listed on the stock exchange with the profits of Seat, or what is recommended here, you compare the own funds of Seat with that of Volkswagen, and you apply the ratio to get an estimated market value. Spain has developed a sophisticated model to value unlisted companies, looking at their actual profits and estimate future profits and apply a price to profit ratio, again, taking similar corporations that are listed. So this is really recommended. In some cases, you don't have comparable companies on the stock market. And all you can do is record the value of the stocks or the other equity as, sometimes we call it the net asset, total assets minus liabilities, which of course in this case exclude equity, to get equity. So yeah, for companies that are not legally corporations, that are quasi-corporations, that is actually the recommended value method, whereas for other companies, we urge countries to really estimate the market valuation, because otherwise we also have quite big differences. France, Spain values a large part of stocks at market prices. Germany has many companies issuing not stocks but other equity, so it's more difficult to compare the countries. We generally recommend to really try to estimate market values. And these estimation methods can lead to negative equity. In some cases, a corporation has more debt than assets. There is still ongoing debate whether you should record negative equity. The ECB kind of argued negative equity only makes sense, here again the legal aspect, if the owners, the equity owners, really have the legal requirement to make up for the shortfall. If they don't, it's not sensible to record negative equity, right? Again, this principle, you only record a claim between institutions if it really exists. If one institution, yeah, it would be useful to have this claim, but there is no counterpart, then you shouldn't record it. Now, the bit special cases, mergers and acquisitions, these are the big events that often occur that really disturb the balance in the accounts. And it's important to treat them correctly. Often we observe them because they are cross-border, and then they might not be treated equally. Oh, that's it. Okay. I thought I should speed up. So speeding up as well, yes. So to state the obvious, but to make it clear, in case of a merger and acquisition, the acquiring company doesn't acquire the individual assets, at least generally it doesn't. It acquires the equity of the other company, of the target company. And that's obviously to be recorded as a financial transaction. The standard rule applies whatever the counterpart is. So the merging company, the acquirer might buy the assets from old shareholders. So financial transaction. If then there is a full merger, the target company really is dissolved into the new company or in a new company, what happens to its old assets and liabilities. So kind of obvious, the assets and liabilities between the two parts of the merger, if there is a full merger, they disappear from the system, I think it's called. That is a other change in volume. It's not a transaction because there are no two institutional units anymore. And generally, the financial assets and liabilities of the target company, they move to the new company, also in the form of other changes and transactions. Okay, but exactly to this, we have this exercise. I show it here, and I must say there was a copying mistake. So, well, it's not very, so why issues debt securities to finance excess shares? Excess shares, you see AF, I use the codes, I think you really have to get used to them in case you didn't, are worth 40. So Y needs 40 billion if you want. It issues debt securities. So that's why you have AF3 debt securities plus 40. In principle, it could get cash for it, but we assume everything happens at the same time. It uses the 40 on the asset side to acquire shares AF4. AF5 plus 40. And then in this example, you move the assets and liabilities to the combined company. And then in the last two columns, you simply consolidate the holdings. So once you have the combined company, there are no shares held by Y in X anymore. The entry is removed by other change in volume. But that's exactly the type of things you should do in the exercise. Similarly, a share swap, we also have an exercise. So similar, but in this case, no debt securities are issued, additional shares are issued, and this is then used to acquire the other company. Listing and delisting. I made the point in some cases that can happen rather quickly and maybe nothing fundamental changes to a company. But at least in the European standards, in ESA, it's explicitly said that listing and delisting should be recorded as offsetting transactions. Users are not always happy about it. On the other hand, it's also convenient because you might see a big listing in your security statistics, and it's something new, it's treated as a transaction. And then it's important to know, is it this really a new company, or is this a listing of an existing company? So this big new transaction in listed shares, you want to offset that by a negative transaction in unlisted shares. Yes.
And why is the reason?
Yes, I think I know the answer, the question. Because users sometimes ask us too, why treat this as as a transaction because the shareholders might not even be involved. One could argue it's a change in the legal characteristics of the instrument. So the shareholders, in a way, they have to approve this. So we say, okay, they basically approve, okay, you pay me back the unlisted shares, and then I invest in the listed shares. But it's really a debate whether this is convenient.
Yes, isn't in that case there should be a revaluation because most likely that the price will change for listed and unlisted.
Well, there can be revaluations, of course, right? But once you know, let's say you go from unlisted to listed, and it's announced it will be listed, and everybody expects because it will be listed, you have more invested, it will be worth more.
Yes.
Immediately you would have a revaluation of the unlisted shares to the value that is expected. So first you have a revaluation, but then again, you just have a swap of the unlisted shares for the listed shares.
Okay, thank you.
I think we have it in exercises too. Short selling is something I should explain. What is short selling? It's when you rent a car, can you sell it? No, of course you cannot. You're not the legal owner. But for securities, in some cases at least, it's allowed. You can borrow a security and sell it. It's sometimes debated why this should be legal, but it's legal in certain cases. In Europe and the US, it's generally legal for securities. And you could say the argument to treat securities different from cars or other things is that there are so many identical entities. It's something different. However, it does pose a bit of a problem. Well, not a big problem, but sometimes you see it even in aggregated data that you have negative stocks for securities. And this does make sense if it's due to short selling. Because what happens? So here we have an issuer. Nothing happens to him. He has issued debt securities. We have the owner or original owner or the owner who is approached by the borrower. Can I borrow your security? And they agree for a lending fee. I borrow you the security for a given time, 1 year. And now, as said, in case of securities, the borrower or short seller can sell the security. He doesn't own it, but he sells it. So the only logical thing is you have to record a negative asset for him. And this is really needed because the original owner still records it as his asset. He only has lent it out. He's still the legal owner. But the purchaser also records it as his asset. So it's twice recorded as asset. You need to record it once as a negative asset. And economically, it makes sense because what's the idea, or sometimes the idea of a short seller is he assumes the value of a security will fall. So I sell it now for 100. I need to give it back to my lender. But I think in a year from now, I can buy it back for 90. So he makes a profit. And why do I say the negative value makes sense? It's he participates negatively in price changes of the security he has short sold. He or she has short sold. So a bit surprising, but I think it's generally agreed. It's quite explicit. I think in BPM 6 it's rather explicit. Yeah. Okay. Do we have time? I have some quick questions. Otherwise, Gerard, it's 11 o'clock, meaning yeah. Okay, let's do it quickly. The first one, loans from MFIs. What is included in consolidated NFC sector debt? Maybe I should say generally debt is considered loans and debt securities, but we concentrate here on loans. A, loans from MFIs, other financial intermediaries, OFIs, rest of the world. Yes, of course. Thanks. Loans between non-financial corporations. No, thank you. Because that you consolidate out if it's within a sector. But to shorten it, if it's loans from non-resident NFCs, you do not consolidate, right? Because it's loans from the rest of the world. It's not a loan within the NFC sector of your country. So even if it's from a loan from within the group of companies. The payment for service is due but not paid. How would you record this?
Receivable payment.
Yes, and to be precise, is it F81 or F89? Now, if it's for goods and service, it's a trade credit. It's F81. B, a bank makes a loss provision as the repayment of a loan becomes doubtful. What do you record in a financial accounts? Nothing, right? Because it's an internal bookkeeping event. It's not a transaction or an interaction with other parties. Pardon?
Like an NPL or
You might record a memo item, a non-performing loan, but in the core accounts, you keep the nominal value. A short-term repurchase agreement between two banks is yeah, you would think it's a loan. Repos generally are recorded not as a exchange of the underlying security, but as a loan. But short-term, I don't know, maybe it's not there, but it's a convention. Short-term assets and liabilities between MFIs are recorded as a deposit, as deposits by convention. The transfer of a loan portfolio from a subsidiary to the parent company. Is this an interaction? Yes, it is. It was a trick question. So the subsidiary and the parent company are still institutional units. At least generally we think so. Unless there is a full merger, any interactions between them are generally financial transactions or genuine transactions. But then the opposite is the transfer of assets from the absorbed. I'm not sure whether I explained it well, but absorbed means it really becomes integral part of the other company. There's only one company left. That is then just the other change in volume, and that's also in the exercises. Then I think I stop here. Yes. So copy. Oh, right, you need to scroll down. I think it is set up. So yeah, we need it like this. Okay. Oh, right. Can we start? So a little or two, well, similar exercises on mergers and acquisition, because this is really the big events that often cause trouble in the financial accounts. So I have several steps here, and you are asked to record the 3 steps in exercise 1. Of course, I hope you're familiar with T accounts. So I only drew the T's, assets, liabilities. There is the target company B, the acquirer A, the shareholders, and the holders of debt securities. And then the first step is A issues debt securities, meaning F3 for 10. What happens in the accounts? You need to fill in some of the cells in the first or in the second here in the transactions. So this is the first step. Then if you scroll down, yes, the second, I actually say, no, one higher, please. T plus 2, I want to see, yes, complete. T plus 2, there are a second set of transactions. I already say it's transactions. A buys B from third party C in cash, meaning F2. And then if you scroll down to T plus 3, bit higher. In T, B is merged into A. You have to say, is this a transaction or other change in volume or a revaluation? And you have to, again, insert some of the cells shaded in blue. And the way it's set up, that's why I recommend you do it in Excel. You then get T equals 3. The stocks after these flows are automatically calculated. Yes, you then might judge if you scroll down. So currently, this is misleading. I still have the old stocks, but if you plug in the flows, the new stocks are automatically calculated, and you can assess then whether you did it right or not. Exercise 2 is exactly the same idea. just the merger is financed differently, and then there is a share swap. Also think about what happens in T equals 1. A announces it will acquire B with a 10% premium on the share price. I hope that's clear enough. If not, make reasonable assumption and proceed. I give it away. There will be revaluations, there will be transactions, and again, there is a full merger. No, there's no full merger, I think. B is still listed. How do you record this? There is no full merger. So I wouldn't say more now. And we have how much time? Until 12 o'clock. Yeah, the explanation is quick. Can you load the explanation? Because I have it. It also has the blank sheets and the solutions. And it's exactly okay. You see already the first. So in order to buy, A has to issue debt securities. So what happens to B? Nothing happens to B. The acquirer issues debt securities. You have the 10 here. And when he does it, he gets 10 in deposit. Sorry, I cannot do this. It's working. Okay. Whereas the debt security holders, they have 10 in assets in F3, and they lose 10 in cash. So that's a fairly standard financial transaction. You have 4 entries, which is also the standard thing in pure financial transactions. You have 2 entries for 2 entities. So that was the first step. Then A buys B from third party C in cash. So that should be easy. A has 10 in cash, and C owns the shares in B. So the cash, that's a negative transaction for A. If you scroll down to step T equals 2. So you have the opposite entries for C. Standard financial transactions. You have 4 entries for, the 2 counterparts. Then third is B is merged into A. Indicate the type of transaction. I gave it away already. It's another change in volume. Right, we had this in my presentation. It's really clear in ESA. It's probably equally clear in the other standards. So in this case, there is a full merger. The target company B disappears. we want to move all its asset and liabilities to the acquirer company. So we have the same entries basically with the opposite signs for the acquiring company. What happens to the shares of target B? They also disappear as a other change in volume. And of course, they were on the asset side of the acquirer. So they need to disappear on the asset side. And that again gives us the four entries that balance. And then if you scroll down, you see the resulting stocks in period 3. So target B doesn't exist anymore. The assets of B has been moved to the acquirer, but the intra shareholdings have also disappeared because it doesn't make sense to record shares which are liabilities of the company itself. It's actually also, a principle in the accounts. You don't record positions against yourself. It cannot expand your balance sheet by reporting assets against yourself. So how many got this right? Just to get an idea. Someone's nodding. Or other questions? Because exercise 2 is quite similar, but a little bit more complicated. In the interest of time, we go quickly to the solutions. Exercise 2. So the one difference is A announces upfront. I mean, there are laws for this. Companies have to announce if they want to take over another company. And they typically have to pay a premium. They have to pay more than the current value. The other assets.
Second, target B.
Target B.
Yes.
Why
It's
did I put
other assets might be 18, I think, because it's not balanced.
Yes, but what did I say? In financial accounts, balance sheets don't need to be balanced. So that was the first, just an indication. And that is maybe typical for a merger target. It's undervalued. Its net assets seem to be 11. Assets minus debt are 11, but the market value is only 10. So it's a typical target for an acquirer, seeing, oh, if I buy this company, I can make a profit. Does he make a profit? Not necessarily, because he has to announce, I buy B. And then others realize, B is really undervalued. So that was the first question. What happens if A announces I will buy B for a share premium? You have a revaluation, the price of A, things happen immediately, and markets will go up to 11. They know they can get 11. So the first entry is the liabilities equity of B go up by 1. And who benefits? The old shareholders of B, right? Not the acquirer, because he doesn't own B already. So in the next step, B has to issue share in order to buy B. And how much does he have to issue? Maybe that's one question. 11. Yes, exactly. I tried to make the numbers simple. Because B is already, the market realizes it's worth 11. A has to issue 11 in shares. So we assume there are shareholders willing to buy them. There will be transactions if you move down a bit. But why do I have a 0 here? The third-party shareholders, okay, they buy the shares issued by the acquirer for 11, but then they swap them for the shares in the of B. So it's they buy plus 11 minus 11. It's a share swap. The net asset, net shareholdings of the shareholders don't change. And we end up with the situation that, yes, the acquirer has now acquired B, and it has financed it by issuing shares. And then we say it's not a full merger. B is delisted, but remains a separate company, a subsidiary. And yeah, I gave it away. The listing is, according to ESA at least, recorded as a transaction, as offsetting transactions. So so what do we still have for B? B still has its outstanding shares. They are bought by A, but they're still outstanding. It's delisted, meaning they have to disappear. They disappear as a transaction. And the offsetting transaction is it issues unlisted shares. You go down a little bit, it should show. Yes. So in this case, B remains. It has no listed shares outstanding anymore, but unlisted shares, it's still the debtor of its securities. I mean, nothing has changed to them, and it remains a debt of the subsidiary. I didn't say anything about it, so you assume nothing happens to it. Yes, that's probably it. We're doing for time. Any doubts?
I think they have to digest the solution a bit. So thanks, Andreas. With that, we come to the end of this. Yesterday and today, we learned a lot about transactions, the kind of transactions, how do you measure transactions? And we also learned that some of the transactions can more easily be measured than other transactions. Yesterday, I think we also touched upon, well, what about more illicit transactions? And that's why we thought it would be a good idea also to include on how do you measure illicit transactions. And for that, we have online Diane Camarini.
Thank you. Hi, can you hear me? Yes, I can see you, but I cannot hear you really well. But if you want, I can proceed to my presentation and sharing my screen. Do you see my screen in full mode? Perfect.
Yes,
Thanks for inviting us, UNCTAD, to present on the statistical measurement of illicit financial flows at this important workshop. My name is Diana Camerini. I work for UNCTAD, now it's called United Nations Trade and Development. I work with the statistics team. And let me just anticipate to you that I'm not financial accounts expert. So I might be somehow vague or very general in some terminologies. But the good news is that what we try to do with the statistical measurement of illicit financial flows is that we try to bring it as close as possible to financial accounts and system of national accounts and balance of payment terminology, so that there will be kind of easy to bridge this type of work together with the compilation of these accounting frameworks. I said I come from UNCTAD, and I will provide you today with an overview about the measurement of illicit financial flows that for which UNCTAD, together with UN Office on Drugs and Crime, are mandated for the reporting of SDG indicator 16.4.1 on illicit financial flows. I will talk briefly about the statistical definition and classification, give an overview of the main estimation aggregates and the links to the accounting frameworks, and a bit of a context on what we do in practice and what we plan to do next. So UNODC and UNCTAD are co-custodians of SDG indicator 16.4.1. This is an indicator identified by the 2030 Agenda of Sustainable Developments, and has been identified as a metric that measures the total value of inward and outward illicit financial flows in current United States dollars. This is a metric that has been identified to measure target 16.4, so to reduce illicit financial flows and combat forms of organized crime, and is part of the goal as a metric to measure achievement towards goal 16. As co-custodian agencies, UNCTAD and UNODC are mandated to collect data from countries that have data and to report them to UNSD for publication to the global SDG indicators database. However, not just this indicator, but many other indicators have been facing the challenges that when they were identified, there were lack of agreements on the statistical definition of, in this case, illicit financial flows, but also other statistical definition of what is the scope of the measurement and what are the methodologies to measure these indicators. Therefore, in addition to reporting, the two agencies are mandated to identify a definition, sit together with experts and identify methodologies for its measurement, and provide technical assistance to countries that would need so to compile statistics on illicit financial flows. This work has started in 2017, where we sit down with experts and we established a task force on the statistical measurement of illicit financial flows to identify a definition and a measurement framework, including methodologies. And the process has proceeded to, let's say, it's found a big achievement in the launch of the conceptual framework for the statistical measurement of illicit financial flows, which you can see a picture of it. The framework has been endorsed at the 53rd session of the UN Statistical Commission by member states in March 2022. The framework includes a definition of illicit financial flows for statistical purposes, a classification, and a broad scope of measurement. To this framework, also, the two agencies have developed specific methodologies to measure specific type of illicit financial flows, which we'll not be exploring today, but they are available on our website. So how we define illicit financial flows? Illicit financial flows are defined as financial flows that are illicit in origin, transfer, or use, that reflect an exchange of value, and that cross country borders. Let me open a bracket here for the Russian interpreters and for Russian-speaking participants to clarify that the term illicit is debated. There appears to be no translation of the word illicit, and this word is at the moment also in the official translation of the name of this indicator being translated as illegal, but there might be some confusions between the two terms. So it is important that you keep in mind that the concept of illicit, it goes beyond illegal practices. This we mean that the practices that are at the origin of illicit financial flows might not just contravene the law, but also may include some practices, for example, aggressive tax avoidance, which are eroding the tax base. And although they are not against the law, they are undermining the capability of countries, specifically developing countries, to finance the sustainable development agenda. Another element of the core element of this definition is the fact that we are talking about cross-border flows. And here we try to adopt a little bit the accounting framework perspective. With the cross-border flow, we mean exchange between a resident and non-resident unit, even if this happens in the same jurisdiction. Another important element is the word flow. We don't want to measure stock, but we want to measure flows of financial and non-financial assets. And we do, for example, don't want to take into account the stock of wealth held in, let's say, tax havens that are deriving from the evasion of taxes, but rather we want to see how much flows are associated with the accumulation of this stock. So this is a flow perspective. We also are not measuring net flows because we want to measure separately the inward financial flows and the outward financial flows per definition. Also, we talk about, the definition talks about exchange of value. Here, it is important that the word financial does not refer to financial assets, but rather to financial transaction. And in the word exchange of value, it means that the financial assets are not the total of assets that amount to illicit financial flows, but we have a comprehensive approach where we include in the exchanges also any other type of assets, including precious metal and other assets that can cross the border. Another element of the framework is the classification of illicit financial flows in 4 main types. We have illicit financial flows from tax and commercial practices. We have illicit financial flows associated with illegal market activities, with corruption, with exploitation ties, with exploitation type, and financing of terrorism. This term that we explained before regarding the legal and separation between legal and illegal activities is relevant particularly for the distinction between illicit tax and commercial practices when we refer to aggressive tax avoidance, which generally are illicit practice but not illegal practice, and illegal tax and commercial practices, which is strictly speaking contravening the law and might include tax evasion, might include trade misinvoicing and other practices. It is also important that we defined separately illegal market activities and exploitation type activities. And here again, we try to reflect the difference between productive and non-productive activities in national accounts. In illegal market activities, we have productive activities. So activities that are aimed to the production of illicit goods, such as illicit drugs, firearms, wildlife trafficking products for which the exchange is illegal, and services, illicit services, such as migrant smuggling. In productive activities, we need to have mutual agreement between actors. And that's why we separated from exploitation type activities that are non-productive activities, as there is no mutual agreements between the actors. So here is the transfer of income. And a big example in this case is trafficking in persons. The trafficking in persons involves an exchange, particularly between the victim and the exploited persons, where there is by definition no mutual agreement because there's exploitation of the victim. And if we can call it a transaction, but it's more appropriate to say exchange, we have a human being. Therefore, we cannot talk about productive activity in this area. The category of corruption is also being separated, as corruption is both a facilitator of the other illicit type of activities and is per se an activity that is prone to generate illicit financial flows, and therefore it is kept as separate. Here, I would like to provide you with a little bit of, let's say, orientation of the term of illicit financial flows compared to some terms that have been explored by researchers, but also in the national accounts, which are the concepts of shadow economy, underground economy, and informal economy. Illicit financial flows are associated with activities that are follow underground activities and illegal activities. There are no illicit financial flows from the activities and the production of units that are operating in the informal sector. If you perhaps are familiar with Eurostat tabular approach to non-exhaustiveness, underground activity pertain to the aggregate N1 of non-registered activities, where we have producers deliberately not registering, so undertaking underground activities and not being licensed, and also producers which are licensed but deliberately misreport, for example, report lower profits to evade taxes. Illegal activities are also falling into the aggregate N2 of non-registered activities, with producer deliberately not registering because they are performing activities forbidden by the law. So a little bit just to give a big overview of the features of this framework and to open to other important parts of it. The framework prescribes a disaggregated approach, meaning that we estimate illicit financial flows from separate types depending on which type we have, and you will understand a little bit more later why. We particularly prescribe, different from the past, a bottom-up approach, which starts from the estimation of the value generated by illicit activities to derive the amount of proceeds available for domestic laundering and for the cross-bordering transactions which fall under the definition of IFFs. The framework is also comprehensive, so encompasses all types of activities that can generate illicit financial flows. And a country can approach the estimation at the country level. So This is being prescribed by the SDG Global Indicator Framework, but also may help also for the compilation of statistics from national accounts perspective. And we tried, as I said, to align it as much as possible to concepts and standards of accounting frameworks. Let me go on with two important elements of the framework, which will guide us a little bit to understand the links to aggregates in national accounts and to the specific flows and how they impact national accounts and financial, as well as financial accounts. We particularly separate between income generation illicit financial flows and income management illicit financial flows. And I'll make you an example to facilitate the understanding. For income generation illicit financial flows, we have cross-border transactions that are performed in the context of production of illicit goods or generate income for an actor during a non-productive activity, and are particularly linked to the functioning of illicit market. If we think about, for example, the production of drugs, and I'll link this example more to types of crime-related illicit financial flows. Let's think about production of drugs. These are the transactions that are associated with import and export of illicit drugs. Therefore, for their estimation, we need to have an understanding of what the legal market dynamics are. With the income management, we instead refer to the income that units decide to invest or consume, invest in financial and non-financial assets, or consuming goods and services. This is something that is more related to what happened after that, let's say, criminal units or resident criminal unit accumulate in terms of wealth and decide what to do later on. And it's not necessarily linked to the dynamics of illicit market activities, but more to choices related to consumption and investment. A separate accounting of income generation and income management, particularly for crime-related IFFs, can help reduce the risk of double counting and allow consistencies with the accounting frameworks. We have been talking about illegal economic activities such as illegal market activities. So illegal economic activities, the accounting of illegal economic activities is possible. And some countries have started measuring aggregates related to certain productive activities, specifically, particularly on drug trafficking. Some countries, National Statistical Office has also started estimating aggregates of relevant for the estimation of income generation, which are, for example, the illicit gross output of units that are operating in legal markets and their illicit intermediate expenditure. The estimation of illicit gross output and intermediate expenditure of resident units that carry out both cross-border activities and domestic activities, it's important to estimate illicit financial flows. And particularly when this unit engage in import and export, they generate illicit financial flows. This is why we need specifically for the crime-related illicit financial flows to have an idea of how these aggregates will amount to have an estimate of the flows. Just to clarify that for illegal economic activities, we bring this definition and we align this definition back to the handbook on the compilation of statistics on illegal economic activities in national accounts and balance of payments issued by Eurostat a few years back. And we reflected the separation of exploitation type activities from illegal market activities, reflecting what is the distinction between illegal economic activities, so transactions, where the two units that are part of the exchange have engaged in a mutual agreement exchange, and whatever is separated falls under the classification of other flows. Again, this is also relevant for National Statistical Office that wish to measure illicit financial flows, to know that Statistical Office, particularly in Europe, have already engaged in the estimation of illegal economic activities. Before, we talked about certain type of flows that pertain to tax and commercial practices, and some other on crimes. Let me switch the focus on the tax and commercial practices now and see how they impact the sequence of accounts. The tax and commercial practices are many, and we have distinguished before between illegal and not strictly illegal, so illicit practices. We identify different type of flows among these two groups. Particularly among illegal commercial activities, we distinguish between flows that are being generated from transfer of wealth to evade taxes, and misinvoicing, particularly misinvoicing happening cross-border transnational trade, and involves over or under invoicing of import of exports. Under aggressive tax avoidance, we identify flows from transfer mispricing, debt shifting, and assets and intellectual property shifting. This is to give you an idea, for the moment is just a theoretical idea, how the compilation of statistics on illicit financial flows in relationship to these 5 flows have an impact or may have an impact to the compilation of national accounts and balance of payments. We see that first in the production accounts, the compilation or the estimation of flows pertaining to transfer mispricing, to assets and intellectual property shifting, and also to misinvoicing may be relevant for the compilation of gross outputs and intermediate expenditure. Flows under the debt shifting in the income generation have an impact or may have an impact for the compilation of generation and distribution of income, particularly in the compensation of employees, in compilation of statistics on interest, dividends, other profits, taxes, and transfer. They also have an impact on the use of disposable income, particularly in the income management part, where we talked about consumption and investments. But here we are just limiting ourselves to consumption. Income management, illicit financial flows from evasion of taxes have a relationship with capital account, particularly with the compilation of acquisition of less disposal of financial assets. And in the financial accounts, transfer of wealth to evade taxes may have an impact on the compilation of changes in assets and liabilities. The same applies to the balance of payments, particularly in the financial accounts, has a similar impact in changes in assets and liabilities. Of course, for the trade misinvoicing, it's important that maybe it's not relevant for this workshop, but that statistics may affect the valuation that has been provided for the compilation of import and exports, which is particularly relevant when a country, units in a country are involved in misinvoicing of commercial trade and trade in goods, both in goods and services. This is a more, let's say, more detailed representation of what we presume to be an important relationship between IFFs and the sequence of accounts in separating income generation operation and income management. Is another way to see the previous chart, probably more complete. So for operations on financial assets and liabilities that are the financial counterpart of the whole set of real operations carried out by residents with non-residents, and have also the role of balancing the financial position in terms of net borrowing and lending. Cross-border operations on financial assets generate IFFs according to the direction of the transaction, inward when liabilities increase or assets decrease, and outward illicit financial flows when liabilities decrease or assets increase. On the relationship between illicit financial flows and accounting, I will stop here, also because we are going on as a maybe too long presentation for today and maybe you're exhausted from the training. But let me just take a little bit of time to give you an idea of what we are doing practically with the countries and how we are progressing to the alignment of the concepts of illicit financial flows with national accounts. UNCTAD and UNODC have also developed, as was mentioned, methods to measure tax and commercial and crime-related illicit financial flows, respectively. So not just the framework with the definition, but also methodologies that have been helping pilot countries to develop statistical capacity to measure illicit financial flows and compile statistics for the reporting of the indicator. We have done, and we are still in testing phase. We have completed testing in 22 countries, but we still require further methodological refinement, which is currently being done in 8 countries. Methodological indications are on the tax and commercial illicit financial flows have been published in 2021 with methodological guidelines specifically dedicated to these flows, and with a recent paper that has been updating a little bit the status of methodological implementation and refined methodologies, a new paper that is called Towards Statistical Framework for the Measurement of Tax and Commercial Illicit Financial Flows. I can send you a link if you want. I think it's also accessible from this presentation. What's next? The 2 co-custodians are still working to bring together estimates from tax related and commercial related illicit financial flows together with crime related illicit financial flows. Preliminary estimates already exist. Some of them are already published in the SDG Global Indicator Database, but now they are disaggregated. What is the challenge now is to solve double counting, solve issues where we have methodologies measuring not just one type of flows, but that have the risk to measure other type of flows, to make sure that are mutually exclusively covering the different type of flows, and then aggregate them into a single estimates for inward illicit financial flows and another total estimates on outward illicit financial flows. We're finally also exploring opportunities to bring in illicit financial flows estimates in satellite accounts. We are currently is really in an early stage to explore this possibility with one of the 8 countries that are refining methodologies. But for this is just a theoretical type of work, but we know some countries have expressed interest, and we really want to engage with them to explore this possibility for the compilation of satellite accounts, which might not be related with this workshop, but it may be relevant for you in the future somehow. Let me close by saying that UNCTAD and UNODC provide technical assistance to countries to help them develop capacity to measure illicit financial flows by themselves. For countries that have never been engaging in such activities and wish to contact us for support in this regard, we have resources, not just guidelines, but also we are developing online resources and training to allow countries to become independently able to measure such flows and include such statistics in their accounts, and bring more relevance and clarity in the compilation also of financial accounts. So if any countries of you is interested, you can contact us, and we can try to understand how we can support any efforts in this sense. So let me conclude here, and thank you for your attention. If you have any question, let's open maybe the floor for that. Thank you.
Okay, thank you very much, Diana, for this very clear presentation. I think what I really like is the consistent and coherent way you design a framework to measure these kind of flows. And as I said, it's not an easy thing to do, but I think the framework really helps. Let's see if there are any questions from the floor. We have a bit of audio issues, Diana, so let's see how it works. Are there any questions? No? Can I ask you a question, Diana? Because in the framework, you make use of in Europe, this written manual on measuring the illegal economy. But if I look in your last slide, there's no European country in the pilot.
European countries, is that finished the question?
Yeah.
Yeah. So in European countries participate in the task force. The task force includes national statistical offices from a few countries in Europe, but so far haven't requested our support for the measurement of illicit financial flows. We have to say that as the UN is focused heavily on developing statistical capacity for countries that lack such capacity, we have been receiving requests more from developing countries, and particularly on the tax and commercial side from countries from Africa, where the risk of outward flows is very high, and where there is more urgency to address the financing for development and metrics that can help the financing for development monitoring and agenda as well in general. But countries have been undertaking some activities so far as we know by themselves. We have no estimates yet, but probably we see that there is interest in such countries. If this is high in the European countries' agenda, we don't know exactly, but we know that they are aware of the framework, and if there is interest in collaboration, we also reiterate that we are available to talk bilaterally.
Okay, thank you, Diana. I'm looking in the room. Yes, there's a question.
Thank you for interesting presentation. I have a question regarding the sources.
I have hard time to hear, as a bit disturbed.
Wait, there will be a new microphone.
Sure.
Sorry, we had problem with mic. My question is regarding data sources. What possible data sources could be used, and also, do you conduct any special surveys?
So the data source depends heavily on the type of financial flows, of the type of the 4 categories we have seen. Every methodology requires different type of data. On the tax and commercial IFFs, we rely already on statistics that are available to customs, for example, on trade misinvoicing, and on statistics that are available to revenue authorities. So not all countries have such statistics, and the availability of statistics is heavily dependent on the type of data that each country has. The methodologies prescribed certain type of data, all the same for each methodology, and depending on what is the availability of statistics in a country, we try to adapt. Every country can try to adapt to what they have. Also, it is relevant for the tax and commercial illicit financial flows, availability of statistics on companies, especially statistical business registries, registers, and other type of statistics on multinational enterprises specifically for the tax avoidance. On the crime side, many national statistical offices do not have access to such information specifically on drug trafficking, seizures, other type of elements that are required. But the advantage here is that UNODC, that has a role to support countries to measure crime-related illicit financial flows, collect official statistics on drug flows, quantity seized, actors. That is also possible to information that is used to identify where an actor is resident in the country, because in the case of illegal activities, it's not that straightforward. And this can help as well. Surveys, we don't have surveys. We have, however, templates to facilitate the work of countries to collect such statistics for the measurement of illicit financial flows. We have this as part of our resources. And we are also developing for certain methodologies codes to facilitate the estimation process following our methodology. So the issue of data is very sensitive, highly depends on countries, and is heavily implying that countries with a low statistical capacity will have hard time to measure such statistics. But we are confident that the work we are doing with such countries will help them also increase the exchange of data and put together statistics in a more substantive manner also for other purposes.
Okay, thank you. I see no further wishes to take. Mira.
Thank you, Diana. It's just another question on clarification. I saw from your slide, I couldn't see it very clearly, but I think 2 of the workshop countries were also included in your pilot. Was it Kyrgyzstan and...
Yeah, let me share my... Yes, exactly.
I was just interested, what is, if you provide more information of the status of the project, do you have already estimates and which are the more prevailing types of illicit flows for the countries? I don't know if the people who are here in the meeting room there in the workshop, they have been involved or they have any information on that as well. It will be interesting to hear the feedback. And another thing, just to raise it to the Russian-speaking participants, I think it will be helpful for UNCTAD colleagues if you provide ideas for how we can translate illicit into Russian. Thanks.
Yes, you're right. Uzbekistan and Kyrgyzstan have been part of the pilot projects. We have to admit that they're not directly followed by UNCTAD, but by a regional commission of Asia and Pacific, ESCAP. They have tested the implementation of methods to measure tax and commercial illicit financial flows. In one of the countries, in Kyrgyzstan, we had conversation with the National Statistical Office, while in Uzbekistan, the authority that is more involved is a prosecution, if I'm not mistaken, authority. In these countries, I know they have conducted a national risk assessment to understand what are the most relevant sources, illicit activities at the source of illicit financial flows. Some of them have started the work specifically on methods to monitor illicit financial flows from gray re-export and related to remittances. I know that there was interest to start activities on measuring illicit financial flows from drug trafficking, but at the moment we are not aware about the status of the progress, but we'll know more in the coming months for sure. At the moment, they have been training on our methodologies and try to collect data. We will know more about the specific methods they will try to implement in the coming months. Regarding the translation, we have had this discussion several times. We have a consultant from Russia that she's working for ESCAP that for which we try to address the issue. It's not easy because it also implies that the official translation of the indicator may have some changes. So far, we are advising through certain type of explanations that we try to go beyond the word illegal, and we make example. So far, the two countries that have been pilot testing the methods are aware, but it's not an easy matter. And so far, we have complemented the conceptual framework that also a translation in Russian with notes advising about this issue in the translation. But yeah, it still has to be solved. But we don't have a workaround, but I'm not an expert in this. I know experts are still working on it. And for now, we have complemented with information.
Okay, thank you very much, Diana. Again, thanks for the very clear presentation. I think this, it shows there's clear interest in this topic. It's not something easy to be measured, but the framework clearly helps to at least think about which parts we can measure. Also good to hear our pilots, and I think that your offer that help is available is clearly heard in this room. So thanks again. And with that,
Thanks to you.
I close this morning's session. We are going to break for lunch now, and we will resume a presentation by Ludmila from the Central Bank of Moldova, and she will talk about equity and other participations issued by non-financial corporations, the value of listed and unlisted shares. Ludmila.
Yes. Could you hear me? Okay. So hello, everyone. And in the following few minutes, I would like to introduce our model of calculation, or what estimation do we have in the field of non-financial corporations equity liability. We do not have such a large experience maybe as other countries, but it is quite interesting for us to move forward towards the compilation of integrated financial accounts. And at the first, I will cover some key aspects of Moldova financial accounts, because I think I need to introduce you in our premises or our conditions, and to better for you to better understand why we are doing it all this way and not otherwise. And seeing the coverage of non-financial corporations will be helpful too. Afterward, I will cover methods of estimations and the compilation of this indicator for different types of non-financial corporations, and showing how we use compiled data may be an interesting thing too. And finally, I will go through some conclusions and future work. National Bank independence and its role as official statistical data provider, together with IMF recommendation and mutual agreement with National Bureau of Statistics, make the legal environment for financial accounts compilation in our country. And both flows and stocks, annual and quarterly data are compiled by National Bank of Moldova. And we collaborate closely with a lot of data providers, specifically with Ministry of Finance, Central Security Depository, Public Service Agency, National Commission for Financial Market. As for National Bureau of Statistics, we have very special collaboration with them, because we did not only collaborate with them as with data provider, they're responsible also for non-financial accounts. So we collaborate in both ways, us with data provider and as non-financial accounts compiler. And hope this collaboration will be even closer for the future periods of time. As it may be, it is the case for many countries. In Moldova, financial accounts is a secondary statistics. We did not require any additional data sources from reporting entities. We just reuse all the data what were required for our statistical or supervision purposes. And what is more important in our case, and we will see why, our whole compilation process is based on a counterpart perspective approach. It means that in our case, we start to compile the first, for each sector, its interaction with other sectors of the economy and with the rest of the world. And after that, we integrate it in the standard two-dimension presentation of financial accounts. So it gives us a lot of benefits because it will facilitate at the very beginning the whom-to-whom compilation. And we already will have this information of interconnectedness and interrelation within the sector of economy. But at the same time, it implies some challenges from the very beginning also. It's not working. Now it's better? It's better? Okay. At this moment, we publish only stock data, and the very first publication was in the February 2023. Time lag is set to be T plus 110 days for quarterly data and 10 months for annual data. But we publish provisional annual data with the first quarter of the next year, so to avoid the breaks in time series. And the availability of the data is from 2015 only for annual data and from first quarter of 2020 for quarterly data. All sectors now are compiled only on consolidated data because we do not have sufficient data sources for non-financial corporations, households, and government sector to be compiled on unconsolidated data. So we started to compile our data on consolidated basis, and afterward we will move forward toward the disaggregated unconsolidated data. And that is also quite important for us. Now we do not have any additional IT solutions for this compilation process. We are working in so-called automatic Excel files. So it's a bit challenging sometimes when we have to process big databases. As for flow statistics, we are working now on the transaction part of it, and we are planning to publish this data till the end of this year. And we do not have many source data on transactions, and they are derived mostly from stock data, which is why we will publish them as experimental data, and afterward we will see public reaction or usefulness of this data, and we'll move toward the non-experimental data. And the quarterly data also compiled on consolidated basis, and the data availability will be also, as it is the case for quarterly stocks, with beginning with the first quarter of 2020. And As far as non-financial accounts are produced on annual basis, we will publish our quarterly data at the first stage as provisional data, and after obtaining annual non-financial accounts, we will try to reconcile this data and to republish or to revise all our published data. And what we are planning to do. As for non-financial corporations, the Public Service Agency publishes each month the register of all legal entities, both registered and already liquidated in our country. And according to our latest data, non-financial corporations is the largest sector, as may be it the case for many countries, according their numbers of entity. And we have 4 types of these non-financial corporations. There are joint stock companies, limited liabilities companies, public non-financial corporations, and some other types of these companies. Limited liabilities companies are the largest part of all non-financial corporations existing in our country. And the main data providers here are National Bureau of Statistics, Public Service Agency, and Central Security Depository. Market prices are not readily available in our country. For example, for joint stock companies, we have only 3 joint stock listed company, and transactions for them are very rare, and it's not possible to estimate actual market valuations for similar equity to apply market valuation for all our joint stock companies equity. That is why the value of transaction is set to be its market value, and the OFBV approach is used for us at this moment. And for transactions, for example, we used the first difference of funds contributed by owners and the contributed surplus, while retaining earnings and reserves are part of revaluation accounts and affect positions only. To be mentioned that not all non-financial corporations are reporting to NBS, and mainly we should to use counterpart data. And counterpart data source in these cases, of course, is the main data source, let's say, for this indicator. And we constantly confront counterpart data with the individual financial statements received from NBS. And using the counterpart data implies that for non-financial corporations and households, we do not have any counterpart data at all. And this data should be somehow estimated. And the ways how we estimate it depends on the type of non-financial corporation, because each type of these 4 groups of these companies differs in the field of the reporting system and requirements. And I will start with joint stock companies. They are not so numerous in our country, and National Bureau of Statistics provide detailed annual financial statement for them. So totals, for example, for this instrument, totals of equity of all reserves are taken from these financial statements. However, these financial statements do not have the information of holders. So we should obtain this information from other sources, and some of this data we could subtract from central security depository databases. But in this institution, not and the coverage is only about 200 of joint stock companies, and not every joint stock company is registered at this institution. So we should apply to our registry companies. And of course, additionally, we try to catch some information from stock exchange to see if we could extract some information about change in ownership in the companies. What we also do, we use web pages of major non-financial corporations because they also publish their financial statements, their decisions, board decisions, so we could catch some additional information from their websites. Speaking about joint stock companies, we receive two tables from Central Security Depository. The first table contains company by company information with unique identification number of each company. And in our country, each legal entity registered in public service agency have this identification number. So first table contains this unique identification number, name of company, value of equity registered or own funds, and weight in total of each holder, if it is individuals or legal entity, or if it is non-resident. In case it is legal entity, this data is included in the second folder, in the second table, where both company and holder identification numbers are included, and included also the weight in total of each holder. What is also important to mention here, in Moldova, we do not have a unique register for sectoral classification of each legal entity. So we do have some register for ISIC classifications, but we do not have sectoral distribution in our country. So we made some kind of projection within our bank and use it for internal use, somehow to see, at least to have a rough idea how sectors, how legal entities should be classified according to their sectoral characteristics. And we take this data and confront it with financial statements, individual financial statements, where we have capital and reserves and funds contributed by owners. So we confront this data identification number by number, and we obtain like aggregated huge database on all companies and their own capital and reserves, and the fund contributed by owners. We have them and at the end distributed by holders. So how we resolve this problem or disaggregate where capital and reserves by holders in joint stock companies. However, we did it only for entities that report to NBS, because not every company report to NBS, and those who not reported are not included in this calculation, because we have not that data for them in financial statements. Of course, this has its shortcomings. For example, for public public non-financial corporations joint stock companies at this moment gives us only the share or the bonding weight of just our state. And the residual is set by us to be other non-financial corporations, but we need some additional database to improve this data quality here. Also, Central Security Depository could provide us more data on major private non-financial corporations, and now we are in process of obtaining this data. And as I said before, stock exchange is additional data source. We analyze all the transactions made on stock exchange to capture the movements and changes in ownership on these companies. Maybe it is worth also to mention here what this data from CSD, Central Security Depository, we receive on and will receive even more data from them on quarterly basis. But from National Bureau of Statistics, we receive financial statement on annual basis. So we should confront maybe, and it is challenging, maybe it's quite an estimation here, because we should confront this quarterly data on holders with interpolated, extrapolated data on financial statements. And of course, it implies some shortcomings and disadvantages, because in quarterly data, we could exclude companies already liquidated, but we do not could include the new companies. And we include them only after receiving financial statements from colleagues from National Bureau of Statistics. As for liability companies, CSD does not have any information from them, but we receive this information from Public Service Agency. They do have macro data on each company, and they receive us also quarterly data which contain identification number of each company, its name, funds contributed by owners, and identification number, name, and weight in total of holder, as well as residence and country of non-resident. So we have quite a detailed information from them, and it is enough for us to compile or to disaggregate these companies' own funds and capital and reserves by their holders. Again, we confront or aggregate this data with our projections on sectoral distribution of legal entities, and after that we confront our data with National Bureau of Statistics. This here we have additional step, because we check funds contributed by owners with data received from National Bureau of Statistics, and we are able to assess, for example, the quality of both data sets. Again, these who are not in NBS data set, or who does not present their reports to National Bureau of Statistics, are not included in our calculations. And at the end of the day, we also have here own funds and reserves and the fund contributed by owners, all the detailed information, company by company. But again, only for entities who does report to NBS. Here, the situation is very similar with joint stock companies, data on holders on a quarterly data, and we should confront it with annual data, extrapolated, interpolated in financial statements. And after receiving the new financial statements from NBS next year, we adjust all our quarterly previously calculated projections. What we have here additionally, we compare all this data from our projections with counterpart data to evaluate the the extent of non-covered entities. It's like an additional, just to have a rough idea how our projections stand far from counterpart data. Because counterpart data, let it be financial corporations or general or sector, reflect all the companies or the assets in these companies. And at the end of the day, we have to integrate all these different parts of our estimations, and we integrate it in our tables. Together with the adjustment of counterpart data, in the sense that counterpart data presumes that they reflect only assets of their companies, and in asset sides they do not reflect reserves and provisions, and we have to adjust all this data properly. The main challenge here is to preserve all the totals, because all the projections affect somehow totals of counterpart data of non-financial corporations, and we believe the totals are very important because they say something of each sector, and we have to do everything to preserve these totals. And the next step, when we have compiled that, when we compile all the data, we compile whom-to-whom data. In our case, we use them in two ways. First of all, we check all the consistency, intersectoral consistency, internal consistency of our data. And afterward, we compile or see or analyze all the compiled data to see the evolution of economical development in our country. And for example, it gives us a perspective of interconnections of non-financial corporations with other sectors, the willingness of other sectors to invest in these companies, and to see these changes over years. So, but to be mentioned that these whom-to-whom tables are used only for internal purposes. They are not published yet. What is how we do this? It is important for us to disaggregate all by holders, because, as I said, all our process is built on counterpart perspective, which is why it's quite important for us to have this disaggregated data to see all the interlinkages between the sectors. Of course, we understand that coverage on non-financial corporations and the National Bureau of Statistics data is not complete, and we should move towards to improve this data, and maybe trying to obtain this data from other sources, from tax authorities, some other administrative data. We do not have yet all the data for joint stock companies, and here a closer collaboration maybe is needed with Central Security Depository or other company registers to complete all our beginnings and to end our estimations. And of course, as I said, balancing is quite a challenge for us, because we do not want lose these totals, lose this perspective of development of each sector. And here might be a solution to create a security by security database where will contain all the information on holders and issuers in the same place, and it will improve our data quality very consistently. So what we do here? And now maybe you could suggest us how we could improve this process, in which way, if you are doing the same, or you have a slight different maybe situation, and could help us with improving in this field.
Thank you, Ludmila, for this very interesting presentation and, well, the insights you give us in your internal process are quite open, so it's very much welcomed. I must say I'm very impressed how you organize the work. I see the guys next to me also nodding. I see the question, but let's also see if there are questions from the floor. Reactions. Yes, please.
Sorry, I didn't really got how do you get the holder of these limited companies? Can you explain a little bit more?
We receive the database, micro database, company by company from public service agency, which have this information. They have like all holders, and they call holder in limited liability companies is changed. Company must to declare this to public service agency. So we have to up-to-date database what we use in our calculations, and here we have no issues here because it's quite consistent. We already receive consistent database from public service agency. And we work with these identification numbers from all our process because it is unique for each company and it is easier to do.
We do something similar, but it's good that we have more data than you. We have data from Central Security Depository by issuer, ISIN by ISIN, and by sector of a holder for all shareholding companies. And we receive this data monthly. We have a database for sectorization, which is Statistical Office is responsible institution for sector classification in the country, and they share this data with us. So we have created in the statistics department, we have created a database for sectorization, and we exchange this data monthly with the Central Security Depository. And according to this data, they classify the holders of these shareholding companies and send us the stocks and transactions on a monthly basis. So it's easier for us.
For joint stock companies.
And we also link data with the stock exchange, and we calculate the quoted and unquoted shares. And it's much harder for these limited companies because they are not registered in the Central Securities Depository. We just take data from annual statements, annual balance sheet, and we calculate and we distribute between households and non-financial companies. And also for government, for public companies, we also put that under other equity because all these public companies are registered under specific law, and the government is 100% owner. So it's since we do have identified this according to sectorization, we have identified these companies. It's easier to us. We know them, and we just take the accounting value from the annual statements. That is how we do that.
But for limited liability companies, the register, I mean, they are registered somewhere. And maybe it is the case to ask them, maybe they have the similar information and they could help you.
Yes, but we don't have information who is the holder of this company. It can be individual, it can be legal entity, it can be one, or it can be more individuals or legal entities, and we don't have that information.
So we are luckier than you. Because while already by company is registered, it obligated like to declare
holding
owners.
companies. That is for shareholding companies. They have to register in the Central Security Depository, and every change of
Should be recorded. In ownership.
of ownership, yeah, should be registered there. But that's only for shareholding companies, not for these limited companies.
We do have this information.
Okay, thanks. I see no further questions. You like? Go ahead. No, you go ahead.
So thank you very much. So, yeah, I was just gonna make sure that I understood correctly, because from the Public Service Agency, all companies have to register with this Public Service Agency, whether they're going to be publicly
each
listed. Exactly. So that's true. So now we're,
Just one detail here.
Yes.
We have all the information of all legal entities, but for example, for joint stock companies, we do have information like which company, how are large funds contributed by owners, but we do not have information on holders. And this information we just capture from Central Security Depository. These lines were with joint stock companies just remains blank. We receive them blank. Yes, limited are very large sector.
second question is this unique number you're showing here.
Identification number, yes. I could.
Oh, yeah, what could share mics here? Sorry about that. I forgot that, yeah, I have to use the microphone. Yeah, so this unique number that you're showing,
Yes.
the identification number that you have here. So is that a unique number that associated when a company registers with the Public Service Agency?
Yes.
So that's the number
And
it's
it
going to
is unique.
stay with them for their entire life?
Yes.
Until they,
Until they liquidated.
And so that's great. So then my question would be is that why aren't you trying to get all the data from the Public Service Agency, and you're relying sometimes on the, NBS to give you some data, and then you're trying to cobble some other data from securities where,
The question here is quite simple for me, because we should use financial statements of non-financial corporations to catch all our data. Public Service Agency have the data only on own funds, and we need totals from financial statements to make these financial accounts. It's the first. And the second point here is that Public Service Agency have like a list of every existing or existed company, and where a lot of companies, for example, that are not active, or they are in process of liquidating, and they do not have assets. And by using all this data, we could distort, or we could give information not so correct on holders.
Right. Yeah, no, I understand that, because I realized that in your first slide, when you showed the number of companies in your economy, there's 40% of those, have been liquidated. So I assume that that
in
list.
all times.
Sorry?
It's in all times.
Yeah, exactly.
Yes.
Throughout the history of
Yes.
this register. So I assumed all that register was coming from the Public Service Agency.
Yes.
Yeah.
Yes.
So, and the nice thing though is that you have the unique number. So the thing is that, by having that unique identifier, you can easily sort of like match the data that's coming from, the NBS.
Yes.
So
and what
again,
we do it-
I would propose that I would start building, my corporate ownership from NBS and make sure that you have a unique number, and then you can attach that unique number or link that database with the database coming from NBS, and then you'll get the full assets
we
and
did
liabilities.
it. We
Yes.
do it the
Yeah.
same.
Yeah.
We just compile in this process.
Right.
We combine by ID number by number, identification number by number. We link all the data received from National Bureau of Statistics, because
Right.
we receive from them also micro data, like for each financial statement for each registered company, and we link it with Public Service Agency with all data, and we receive consistent database for non-financial corporations.
Oh, so it's very good. I think then the next step would be for the NBS. They have to follow up to find out, why they're having such a low response, to try to see if they could increase the response rate. But that's going to be maybe something that they have to work in. But my last question is that, yes, the own fund book value is, one of the recommended approaches, to value unlisted equity. But because you're using it strictly for non-financial corporations, the only thing I would say is that you have to be careful, because when you use the own fund for book value, it's going to exclude any IPPs. So if IPPs are, significant in your economy, you're going to have to try to somehow to get those assets, within the calculation of the own funds at book value. But I'll stop here.
Okay, thanks, Emmanuel. No, that's okay.
And one more comment maybe for small reporting on NBS. I think that most of active companies are reporting to NBS, and the companies who are not reporting to NBS, they are either just registered and not active, or just new established, for example, in this quarter, and they did not manage to do their financial statements yet. So because we made this, as I described, we made this research, how large is from counterpart data. We compared this data, and the discrepancies are not so significant. So the coverage is quite good.
Maybe you shouldn't put the comment, but only for entities that reported to NBS.
It's
Okay.
I pointed here.
We have a coffee break in half an hour. So, no, sorry, but also given the time, I think thanks again, Ludmila, for the presentation. Like I said, it gives a very good insight in your internal process, what you do, and we were impressed. It also triggered some questions, also some good discussion. So, thanks again for this wonderful presentation. No, that's okay, Emmanuel.